Welcome to the deep dive. Our mission today, well, it's pretty direct. We're diving into your source material to figure out what this really powerful signal from September means for the rest of 2025. Because, the S&P 500 just closed out the month with a pretty stunning 3.5% gain.
Yeah, that 3.5%.
Yeah.
It's not just a good month. It's actually the best September performance the market's had in, 15 years?
Mm-hmm.
It's a big deal psychologically, too, especially when you think about what September usually does.
Absolutely. And, while we're taking that in, the market just keeps climbing. Closed yesterday above 6,700. First time ever. Another all-time high. It kind of feels like those bullish calls from earlier this year are really playing out.
They really are. You might remember back in May, the source data suggested a surging S&P 500 usually leads to about 18.7% gains over the next 6 months.
Yeah.
The incredible part, the market hit that 18.7% in just 5 months. Just shows you the kind of momentum we've seen.
So, okay. We've got this fantastic-looking index, a historically strong signal pointing towards a good Q4. But this deep dive, it isn't just about patting the market on the back, right? The real mission here is to look under the hood. Because while the headlines are screaming all-time highs, your sources are flagging this.
Yeah.
Big rotation starting up. Sounds like potential trouble for a lot of stocks.
That's precisely it. The gains look great on the surface, absolutely breathtaking even, but they're getting narrower. So we need to lay out two key things for you today. First, why history suggests Q4 should be strong. And second, where the big money is actually flowing right now, because honestly, the gap between the winners and the losers, it's becoming massive.
Okay, let's start there then with that September signal, because like you said, it really does fly in the face of the usual seasonal patterns. September is normally, well, it's the month investors kind of dread, isn't it?
Oh, totally. It's usually the seasonal graveyard. If you look back, say, to 1990, the S&P 500 averages a loss in September, negative 0.7%.
Yep.
You usually see selling, maybe some profit taking after summer, institutions shuffling things around before year-end. It's just reliably weak.
So getting a 3.5% jump, that's basically flipping the script on like decades of market behavior. How unusual is that exactly?
It's really rare. Since 1990, we've only seen 8 times where September actually managed to gain 3% or more. I think years like 2013, 2010, 2009. Often these were specific moments, maybe after a crisis or a correction that then set up for big rallies later on.
Okay, but here's where I get a little, maybe skeptical is too strong, but cautious. 8 times in 35 years. That's not a huge sample size, is it? How much predictive power can we really assign to that? Is it just, a coincidence, or is there something really there?
That's a perfectly fair question. And yeah, the sample size is small. But the outcome in those instances has been, remarkably consistent. It suggests that this specific trigger, a really strong September, signals something about institutional mindset. Like if big players are buying heavily during a month that's normally weak, it often means they're positioning quite aggressively for the end of the year.
Okay, that makes sense. So what does that aggressive positioning lead to? How does the fourth quarter typically shape up after one of these rare, strong Septembers?
The difference is pretty stark, actually. Look at a typical Q4 since 1990. The average return is decent, right? 4.91%. Respectable. But then filter the data just for those years after a September that gained 3% or more. The average Q4 return jumps way up to 7.63%.
Wow. Okay, that is a big lift.
It really is. That's 7.63%. It represents a 55% increase in performance compared to your standard Q4. So the conclusion from the data seems pretty clear.
Yeah.
Big September gains tend to signal big Q4 returns, historically anyway.
But why? Beyond just institutions or positioning, is there a mechanism? Are we talking simple year-end window dressing, or is it like genuine FOMO kicking in for managers who suddenly realize they're lagging the index?
It's probably a mix of both,
Yeah.
Think about it. The market starts putting up these huge gains late in the year. If you're a fund manager measured against the S&P 500, you suddenly see this massive performance gap opening up. That panic, that fear of missing out, it can force you to pile into whatever's working, into the winners. That chase itself creates these huge self-feeding flows in October, November. The positioning becomes the fuel.
That adds really valuable context. Okay, so let's pivot now. We have the historical optimism, but you flag this present-day warning sign, this dichotomy. Despite the history, despite the all-time high, something's off. You mentioned equity outflows.
Yeah, this is where things get really interesting and maybe a bit concerning. The S&P hits 6,700, right? Headlines look amazing. But when you peel back the layer, institutional tracking shows we just saw the biggest wave of equity outflows, money being pulled from individual stocks in months.
Yeah.
Your average stock, it's not really playing along in this rally.
So you've got this split. The index looks strong, but the market's internal health maybe is weakening. How does that even work? How can the index go up if money's flowing out? How do you visualize that tug of war?
Right. It comes down to market capitalization weighting. The S&P 500 isn't just an average of 500 stocks. The biggest companies, the mega caps, they have this enormous weight. So if just a handful of those giants are attracting massive amounts of money, they can completely mask selling pressure across hundreds of other stocks.
Ah, okay. So a few heavyweights are basically carrying the whole index uphill, even while lots of others are actually losing ground.
Exactly. And to track this internal dynamic, we use something called a big money index, the BMI. It basically monitors the daily flow of money buying versus selling across thousands of stocks. When the BMI is going up, it means market breadth is good, more stocks are being bought than sold, accumulation.
What's the BMI telling us right now?
It's telling us the market is getting narrow, fast. The BMI recently dipped to 69%. Now, technically, that's still considered bullish territory, but the direction is down. And that confirms that specific pockets of the market are seeing pretty aggressive selling.
Let's get specific then. What did the flows look like on the most recent trading day? You said that really showed the tension.
It did, yeah. The data showed 137 individual stocks had green inflows money coming in. Okay, that's positive. But on the same day, 98 stocks saw distribution warning. They were being actively sold by institutions, getting nearly 100 stocks sold off like that in one day. That's the most intense outflow we've seen since early August.
Hold on, let me just process that. Nearly 100 stocks getting hit with selling pressure. How on earth does the S&P 500 hit a new all-time high on that same day? That sounds incredibly fragile, like it could snap back hard.
It sounds fragile because it is narrow, and that's where these 6 stocks come into play. The data revealed that only 6 large-cap stocks saw significant inflows that day. Just 6. But these few elite names are weighted so heavily in the S&P 500. The sheer volume of institutional cash pouring into just those 6 was enough to completely overpower the selling pressure hitting the other 98 names combined.
6 stocks, overriding the negative flow from almost 100 others. It really drives home that point about the gap between winners and losers becoming this huge chasm. Okay, so if big money is ditching nearly 100 names, where's that cash going? Which brings us to the rotation specifics.
Yeah, you see very clear thematic moves. The money isn't just vanishing, it's being actively rerouted into very specific areas.
Okay, so who are the winners? Where's the accumulation happening?
The sectors getting the bulk of these inflows, and you're seeing it in their prices, are healthcare, industrials, and then a very specific part of technology, the semiconductors.
And who's paying for this shift? Which areas are being sold off, seeing that distribution?
The outflows are hitting consumer discretionary pretty hard. Financials too, and then the other side of the tech coin, software stocks.
That split within technology itself.
Yeah.
That seems like the perfect illustration of this division you're talking about. Tech is somehow both a huge winner and a huge loser at the same time.
It's probably the clearest example, yeah. Investors are definitely differentiating. You've got these just breathtaking rallies and massive institutional buying in the big semiconductor names, companies building the foundation for AI. But at the same time, many software stocks, maybe ones that just rode the general tech wave before, they're seeing consistent selling day after day.
So investors aren't just blindly buying tech anymore. They're making very specific bets on who they think the real AI winners will be. And they're, well, pretty ruthlessly selling off the ones they see as losers or maybe just not direct beneficiaries.
Exactly. It's almost like a risk-off rotation within what's normally seen as a risk-on sector. And you see a bit of that defensiveness playing out in healthcare too.
Right. You mentioned a really strong ongoing trend in large pharmaceuticals.
Yes, absolutely. Big pharma stocks are seeing heavy demand. It suggests investors are maybe shifting towards a bit more stability, essential services, even while they keep exposure to those big growth themes like AI through the semis. ABBV, that's a great example from the source data. It's been pulling in significant inflows week after week. Consistent institutional buying there.
Okay, so we've pulled together a lot here. We've got history suggesting a strong Q4, that 7.63% average gain, maybe fueled by institutional FOMO. But then we have the current reality. A rally that looks fragile, maybe driven by just 6 stocks, while intense selling happens elsewhere. What's the bottom line here? What's the key takeaway for you, the listener, trying to navigate this?
I think the main message coming out of the sources is that stock picking is just absolutely critical in 2025. You really can't just rely on the broad index going up if, 98 out of the 100 stocks you might potentially own are actually seeing outflows. This fast rotation is going to keep pushing those chosen winners, the big six, the semis, the steady farmers higher, while really hammering the stocks that fall out of favor.
That sums it up perfectly. The overall tide might favor more upside into Q4, historically speaking, but actually succeeding seems entirely dependent on being on the right side of where that big money is flowing. Understanding those flows isn't optional anymore.
That's the core idea, yes. The guidance seems pretty clear. Don't just follow the headlines or the day-to-day news chatter. Go with the flows. Follow where that concentrated capital is actually going.
That's a really strong way to put it. But before we completely wrap this deep dive, let's leave you, our listener, with one last thought to maybe chew on.
Yeah.
Something that builds on this idea of extreme narrowness. We established that even with the biggest outflows in months hitting the market, just 6 huge stocks were apparently enough to drag the entire S&P 500 to a brand new high.
Those six stocks basically are the market at this exact moment.
Precisely. So it raises this really crucial question for you to think about. What is it about those specific 6 stocks? What unique fundamental strengths or technical picture or maybe specific flow characteristics allow them to just soak up all this rotational selling pressure elsewhere in the market and keep attracting that massive institutional backing? What makes them so special that investors are willing to ignore nearly 100 other names getting sold off?
Yeah, think about what kind of business moat they might have or how essential their service is. What gives them that kind of gravitational pull, even when everything else feels a bit shaky? That's the real puzzle hiding underneath this latest all-time high, isn't it?
That is definitely the question to ponder until our next deep dive. Thanks for joining us.